Welcome back. This is the Bookkeeping Master on YouTube. This is part 2 of control accounts, the basics of control accounts. If you've started this series here, I suggest you go back and watch part 1 and then come to this video. So a quick review of what I went through in the last video. We spoke about debits and credits, just to give you a quick refresher on debits and credits, because it'll help you to understand control accounts better if you just have a quick refresher on debits and credits. And I went through the whole pearls in that video. I had some examples of recording business transactions using double entry bookkeeping, so debits and credits. These were all cash purchases, cash sales. What I mean by cash purchases, cash sales, money was exchanged hands when goods were either bought or sold, or services were sold. And goods were bought or services were bought. Then on this next tab, I tried to make it clear to you why we need control accounts. I gave a few examples here, like this first one. If a business makes a sale of £100, but it's on credit, what is the debit entry? We record the sale, but usually with a cash sale, the debit would be bank account or petty cash. But if there's no money changing hands, what happens with this debit entry? And then looking at a purchase or an expense, if we or a business purchased £5 worth of stamps on credit, we can record the debit entry. So going back to debits, expenses are debit. But where does the credit go? There we go. Where does the credit go? Because no money's changed hands, usually we would put credit bank or credit petty cash. But that is not the case because no money has changed hands. And then I looked briefly at tax as well. What do you do with tax? Sales tax, to be more specific. I am struggling with my voice a little, so you have to bear with me if I go a bit croaky. But I'm trying to do my best. My kids are also off school. It's the summer holidays here in the UK. So if there's any background noise, then just ignore that. I have 3 boys and a little girl, and they can be pretty loud at times. So hopefully at this point you understand why there is a need for control accounts. And the couple of reasons that I gave in the last video were, first of all, we need to keep account of how much is owed to us and how much we owe to others. So that's one reason why we need control accounts. If we have lots of sales on credit, how do we know who owes what and how much is owed to us? And the same with purchases. If we're purchasing on credit, how do we know how much is outstanding to our suppliers? So that's one of the main reasons why you need control accounts. And then another reason is you need to account for everything accurately. You can't just have a credit for sale and then not enter a corresponding debit. It's double entry bookkeeping. It can't work. Accounts are not accurate if there's just one side of an entry. So we need some way to record a debit transaction. And with this example, a credit transaction. So that's where control accounts come into play. So control accounts. Because what a control account will do is it will fulfill a role that fills that void. Those 2 reasons that I mentioned of being able to account for everything that is outstanding. A control account will do that, and it will help you to record accurately both sides of a transaction. So with this first example, the sale is a credit and the debit would go to the sales ledger or the sales ledger control account. This is an asset account. It's money that is owed to the business. And then what would happen is when that money is finally paid in, say the customer pays after 30 days, that amount will be cleared off by crediting the sales ledger control account, and then the money would go into the bank or petty cash, however the payment was made. So we have like two transactions in this example here, and it's the same with all control accounts if payment has been made. So let's look at this example: business purchase of stamps and credit. So the credit will go to the purchase ledger or the purchase ledger control account. That is a liability account, so we'll have £5 on that account that we owe. When we finally make payment, it will be cleared off that account. The liability is no longer there, so you would debit the purchase ledger control account and then credit, say, the bank account if we pay by card, or if we pay by cash from using petty cash, you could put petty cash there. Now, don't worry if you haven't managed to take all of this in, because I have some examples here. So I have some T accounts here: bank account, petty cash, purchases, sales, sales ledger, control account, purchase ledger, control account. And I plan on just going through some transactions with you. I want to try and keep this as simple as possible, so I'm not going to bother with dates or closing accounts off. And I don't have credit accounts either. I should have like a sales return account, a purchase return account, but I just want to keep things as simple as possible. The purpose of this video is to teach you about control accounts. I don't want to get into the nitty-gritty of other things. So let's say a business makes a sale. Okay, so usually if there's a sale, let's say it was a cash sale of £150, we would credit the sales account, that's the credit, and the debit, let's say, went into petty cash. That would be the corresponding debit. So we have credit 150, debit 150 into petty cash. Pretty straightforward, just like I went through on this tab here. But now let's do a credit sale. So once again, we need to record the sale. So we'll do credit sale, and perhaps you would have a customer account number, or just some way to record that. So that's their account number. So you still record the sale. Let's say it was £75, but no money changed hands. So we don't want to debit petty cash, because that's not what happened. We don't want to debit the bank account, because that's not what happened. I think a lot of mistakes when it comes to accounting, a lot of mistakes that are made, people are just not thinking about what's happening. All you're trying to do is record what actually happened in the business. So there wasn't a cash sale. No money went into the bank. No money went into petty cash. The money's actually still owed to the business. So it goes to the sales ledger control account, and this is an asset account, and assets are debits. So you can see that there. So in here, I'll just put sale PO 14. And there we have it. That's the debit, that's the credit, sorry, and that's the debit. Done. Now, when this amount is paid, because at the moment this is an asset account and we're owed £75. When this amount is paid, let's say he came in or she came in, they paid the money, and that went to petty cash. They paid in petty cash, or to petty cash. And there we have it. The amounts balance each other out. There's nothing outstanding on the sales ledger control account, because there's nothing outstanding. There was one invoice outstanding, and that's been paid and has gone into petty cash. Pretty straightforward, I think, but I've been doing this for years. Okay, so let's have a look at some purchases. So let's say a business makes a purchase. Purchases are debit entries. So there was a £100 purchase. And let's say we paid that from the bank. So money out of the asset is a credit and purchases are debit. So we have our debit, let's do the credit. Okay, pretty straightforward, just like on this tab here, just a cash purchase. Now let's say we have a purchase on credit, say that's a big one, say £500, and it's not an asset purchase, it's just a general purchase. So £500, we still need to record the purchase, and that's a debit side. So £500, where does the credit go? Because no money's come out of the bank, no money's come out of petty cash. The credit goes into the purchase ledger control account. So as we did before, let's put our account number in. Could be something like that. I don't want to confuse things now with monetary amounts and references. So it's 500, and there we have it. Pretty straightforward. So the purchase ledger control account is money that we owe to our suppliers. It's a liability, and currently there's a £500 liability. We owe £500 to this supplier, whoever that is. Now when we get around to making payment, we need to clear that off. So £500. And how did we pay for that purchase? Well, let's say we actually paid through the bank. That's the most likely thing to happen. And let's just do that. So now the liability account is 0. We don't owe anything, and everything has been recorded. So hopefully that makes sense. I said this in the last video, but if this has gone over your head, then just go back and rewatch the video. It could be that you just need a refresher of the basics. So if that's the case, just go to my website, freebookkeepingaccounting.com. There are free courses all about debits and credits and basic accounting, basic bookkeeping. They're all videos like this. So it's all for free. So just go and have a look and then come back to this video. Hopefully this helps. Please like, it really helps when I get support for these videos. So please like, please subscribe if you haven't already. Please feel free to check out my other videos. I have over 230, I think, over 230 bookkeeping and accounting videos. They're all for free. So please go ahead, check them out. You can make a donation on my website too. Just go to the website. Any donations help keep the website going and support these videos that I upload. Thank you for watching.